Two cheapest growth stocks to buy in the stock market right now. This is what I'm going to talk about, and I truly believe those two growth stocks are presenting the best buying opportunity amongst growth stocks in general. The first one is a stock that I own. I bought it many times. I still believe it's presenting an opportunity. The second one has been going down, but I believe the company could be nearing an inflection point. And that's why I'm going to talk about it. It's very important for me to do an update, and I really hope you enjoy this video. And I'm going to get started with the first stock, and this is Hims and Hers Health. This is the stock that I own. I bought it at $8, then at $5, then at $11, and I bought more shares recently at $21. Now the stock is sitting at 32, and I'm just being very honest with you. If I did not have a position in Hims and Hers Health, I would be seriously considering the stock and just doing my research to understand the fundamentals. But the main reason why you would skip the stock is because it's up. This is the main reason. And maybe it's the main reason you skipped Nvidia and all those stocks. Just because the stock was up, you're scared it's going to go down, and you believe it has already played out, and you're late to the party. And I used to make the same mistakes for so many years. I missed on so many amazing opportunities. Just because I looked at the chart, I'm like, oh, the stock is up 200%, so I'm late to the party. What if it still has 2,000% worth of potential? Does it really matter? When do you want to get in? Do you want to get in on IPO? This is when you feel comfortable. Like, all that stuff is stupid. I'm just being honest. And I learned it the hard way. I learned two main lessons. The first lesson was that this chart doesn't matter. What matters is the fundamentals. And if the stock is up 100%, but EPS is up 200%, the stock could be cheaper now than it was before it went up 100%. But psychologically, we can't understand it because we saw the stock being 50% cheaper in terms of a stock price, but it's not in terms of the fundamentals. And this is the main lessons that I learned. The second one is sometimes the stock goes up before the fundamentals. And the fundamentals, they tend to follow the stock price, not the other way around. For example, sometimes you look at a stock, even you could say maybe Palantir, Nvidia, Hims and Hers Health, it's up, it's up around 55% on the month. And the last month was also up like 40%. And it just keeps going up. And sometimes a stock like that would go up, and people would look at it, they would say, the stock is up 55% on no news, so it has to come down because there's nothing that's justifying the 55% move. But sometimes the stock is moving in anticipation of good fundamentals. This is what happened to Hims. That's why, the stock went up so much and growth was following the price. The price wasn't following growth. And this is a big difference. And this is why, Nvidia, for example, never looked cheap because the fundamentals were following the price as the market is forward-looking. And those are very important lessons. I'm going to talk about them a little bit more on Sunday, so stay tuned. And this is a business model. They are mainly in telehealth, massive TAM and that stuff. Sexual health is 80 million people in the US. Dermatology, hair loss, acne, especially hair loss. They're big in hair loss, 80 million United States. Mental health is 100 million. Weight loss, which is very popular for them, was selling those compounded GLP-1 kind of shots, whatever you call them. And this is the biggest mistake people make, is they believe, Hims is up so much because they're selling the GLP-1. GLP-1 is like 6% of revenues. Hims grew 100% plus in revenues way before GLP-1. But people are just so lazy to do research that they believe the entire thesis is GLP-1. I mean, this is the truth. And that's how the stock is trading based on GLP-1, which I'm going to talk about, but it's really dumb because, mental health is 100 million, but dermatology is 80 million. Hims doesn't need GLP-1. And they have certain weight loss pills that are much cheaper than GLP-1. GLP-1 is $200 a month with Hims. And you have to pay, I believe, 6 months in advance, which is like $1,200. Most people don't have that stuff. So they take the weight loss pills with Hims, which I believe are $99 per month, or sometimes $69 per month, which are much cheaper than $200 per month for whatever they do with GLP-1. And revenue has been massively growing, up 77%. Subscribers also massively growing, 44%. And margins have been improving, 79% gross margin. Or actually, they haven't been improving. They've been going down a little bit. But it's very high because Hims doesn't really, most of their products, they don't actually manufacture them themselves. They use some kind of a third party medical companies, and they do the stuff for them. They repackage it and they advertise it and they sell it for a profit. It's a beautiful business model, very efficient. and they have 79% gross margin. Most of their expenses are spent on marketing, which is where they should be spent for them to focus on growth. The company should not be focused on profitability, even though the company has been GAAP profitable for 4 quarters in a row and it's been improving. The last one wasn't accurate. It's not 75 million. It's around 15 million because they had 60 million worth of some kind of a one-time tax benefit. So it was 15, and the last one was 13, the one before 11, the one before was 1.2. So they're not really focused on profitability, and it would be dumb to focus on profitability in such early stage in the business cycle, but they're still GAAP profitable, and they're not losing money. And this is something that's very important. If you look at guidance, it's only been getting better for HIMS. And in terms of Q4 2024, they're guiding 81 to 91% revenue growth. This is insane. 91% revenue growth. The last one was 74%. The one before was 44%. And again, we're talking about why, sometimes the stock price goes up before the fundamentals, because it's expecting something good to happen. Not all the time. Sometimes we have irrationalities. But a lot of times, this is what I noticed with a lot of good companies. But 91% revenue growth. And the companies, they tend to be a little bit more conservative so they can beat on them. They never get too optimistic with guidance. So they might even be able to beat, 91% revenue growth, which is absolutely insane with the company. And I'm going to talk about two concerns before I get into the valuation. And the first one is mainly competition from Amazon, because people believe that if Amazon enters a space, like HIMS is dead, that's it. Like you can't compete anymore. And this is wrong. And I talked about it in this video, that Amazon did go in a lot of spaces like food delivery and other spaces, and they failed. They went into smartphones and they failed. So if they're going into mental health and in telehealth in general, it doesn't mean they're going to succeed. And if they succeed, Amazon is not going to have 100% market share. The market is so huge, it could afford many different players. 100 million in mental health alone, 80 million in dermatology alone. Amazon is not going to have 100% market share. It's not even going to have a 50% market share. And I doubt they get 20 to 25% market share, maybe maximum. Even in e-commerce where they dominate, they don't have 100% market share. So people act like, Amazon is coming in, so it's over for HIMS. This is not true. And it provided amazing buying opportunities on the stock. And just don't pay attention to this noise, because the market is so big, they could do many different things. And the second thing with HIMS and Hers Health is the whole drama about GLP-1, that they sell this compounded product and they have the FDA has this product, the GLP-1, on a shortage list. And that's why HIMS can sell a compounded product that's not FDA approved. And if it's no longer on a shortage list, HIMS will no longer be able to sell the product, which means, then the growth is dead. And this is not true at all, because it's only 6%. And if you look at what HIMS did before, it grew 100% revenues many times, way before GLP-1. So the whole GLP-1 stuff is all drama. And it's just people, they don't want to do research. They want an easy answer of why they shouldn't own HIMS because of GLP-1. Easy. Okay, leave it alone. The stock is up 200% and they still talk about GLP-1. So just do your research. You're going to understand that GLP-1 isn't as big as a lot of people believe. You look at forward earnings, price to forward earnings, it's at 36 times. This is dirt cheap. But I have to be honest, this is with stock-based compensation. The company has a lot of stock-based compensation. Without it, they would be trading maybe 80, 85 times earnings, I believe. You could look at it and adjust it. And it's like 85 times earnings, which 85 times might sound expensive, but it's not as expensive as you would believe, because the company has been massively growing in terms of earnings per share. 161%, 222%, 286% growth, 220%. So you're not even buying it at one-time PEG ratio if you're paying 90 times earnings on a GAAP basis. But on a non-GAAP basis, you're paying 36 times, and the company is growing earnings per share 100% plus. This is absolutely insane. And this one wasn't 682% because of the tax benefit. But the main reason why I believe HIMS right now is presenting an amazing buying opportunity is because the analysts are wrong. And that's what I believe. And the main reason why the analysts are wrong is because they're expecting, HIMS and Hers Health to go from 220% earnings per share growth. Just this quarter, they raised guidance to 91% revenues. So they're expecting HIMS to go from 220% EPS growth to only 16% next year, and then 17% in 2026. This is insane. And if it wasn't for that, I would say Hims is overvalued. But if those estimates they get revised higher, it's dirt cheap. It's dirt cheap. And I believe Hims in the short term should be trading at least $40 per share. And it still wouldn't be expensive for the growth that I showed you. But the analysts are making a huge mistake. It can't happen. Like it can't go from 200% to 16%. That's crazy. I would be shocked if that actually happens because the TAM is so huge and the company is only getting started. So I like Hims and Hers Health over here. The stock is still cheap in terms of the estimates. Even if they grow half of that instead of 200% EPS, they grow 80 or 90% EPS. So still paying one-time PEG ratio on a GAAP basis. Non-GAAP, you're paying 36 times earnings with no debt. That's dirt cheap. I still like Hims and Hers Health, and I believe it's the best buying opportunity in terms of growth stocks in the stock market. The second one is CELH, which is Celsius Holdings. It's down 51% year to date. It's been a crazy one with this one. It was one of the best performing stocks ever, up 1,700% over the last 5 years. And now it's down like 55%. And they mainly market themselves as more of a healthy energy drink. And a lot of younger people, they like, the product of Celsius, I would say. And the main problem with Celsius is the growth. It went from 140% growth to 3%. And this is terrible. And the main reason why it went to 3% was due to a few reasons. And the first one, maybe you're familiar with what happened in terms of Pepsi, because they have a huge partnership with Pepsi, and Pepsi owns a stake in Celsius, but they overstocked Celsius products, so they're not buying any more Celsius stuff because they're trying to get rid of inventories. And it has been challenging, and this is what the CEO said. But he did say, we believe it has largely stabilized, but it had an outsized an adverse impact on our operating results during an otherwise solid quarter. So he believes it has largely stabilized. So it's likely nearing the end. And this is something that's important. The second reason why CLH has been struggling is because the entire market is facing slower volume. CLH in orange is still facing 2.8% increase in volume. But most of the other stuff, Monster, Red Bull, they're all facing declines in terms of volumes for energy drinks. And they were massively popular before that. And they're still very popular and they're still gonna grow. But it's hard to beat such numbers year on year because 2023 was such a huge year for all of them. 2024 is gonna be very hard to beat. And this is one reason. But I believe the main reason why, the analysts are also making a mistake with Celsius is because of international expansion. And I talked about how the company gained massive market share in the United States from an unknown companies. They gained massive market share and they took market share from Red Bull and many different energy drinks. And if they were able to do it in the United States, why can't they do it in Europe? And why can't they do it in those other countries, which they just went into a few months ago? They just went in Canada, in France, Ireland, UK, just a few months ago, and they're expanding over there. And it's been a huge success so far. And that's the main thesis around Celsius, which people don't pay attention to, is international expansion. International was up 37% so far, and year to date it's up 36%. For revenues in North America, it's 4%. International is 36%. And the company is just getting started. And internationally, they could possibly be as big as they are in US. US is 247 million in revenues. International is only 18.6. But it was 13.6 last year. So it's massive, massive growth. And once the stuff stabilizes with Pepsi, they're not only going to have 37, 40% international growth, but they're also going to have decent growth in the United States. So in total, the growth should start picking up next year in 2025. And you have a new year. You have some kind of a change in sentiment on those stocks. This is what normally happens. And it has massive potential for recovering. And the company is making acquisitions. They just acquired, some kind of a facility for them to increase production. So if they don't believe this is a one-time event, why would they be acquiring more capacity to increase productions? And this is not outside the US, this is inside the US. So that's insane. And the management is very smart. They were able to do all these things, gain market share, very smart in advertising. I don't believe they're stupid enough to acquire more capacity if they didn't really believe that it was a one-time event and it's going to get better from here. So this is a very interesting proposition with a new year and everything that's happening. It's getting very, very interesting. I'm just being honest. The stock right now is trading at 33 times earnings, forward earnings, which might sound very expensive. It was at 250 before. Now it's at 33 times. And it might sound expensive, but if you look at the potential earnings per share growth for 2025, it's expected to be 38%. And it could potentially end up being 30 to 35% for many years to come. And this is the speculative part. Most of those growth stocks are speculative. So if the analysts are right on this one, and international growth does pick up, and US markets stabilize a little bit, and if they can grow earnings per share 30% for a few years, you're paying one-time PEG ratio, one-time price to earnings growth. And this is very cheap for any growth companies. Anytime you could pay one or below one-time price to earnings growth, you're likely getting a very good deal. You're getting it with Hims and Hers Health, way below one peg, and you're getting it with Celsius. I believe Celsius is more speculative than Hims, but it has much more potential in the short term because of the massive decrease in the stock price. And selling puts is very interesting if you like that stuff on Celsius. I've done it before. So I like Celsius, I like Hims and Hers Health. Both are speculative, but I believe Hims is a little bit safer. They both have good balance sheets, and that's my opinion on them, not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.